I think that the people who are big fans of Trump and expect a roaring stock market and a continually strong economy are going to be very disappointed. Government spending was just out of control. All the different levers that the Biden administration could pull to juice the economy got pulled.
A lot of the growth right now is bought by government spending.
We are in this volcanic eruption of the entire currency world running into the dollar right now. How on the earth can the dollar remain this strong?
Welcome to Financial Face-Off, where perspectives clash and insights thrive. With our host, Porter Stansberry, and his guest, Peter St. Onge, we'll break down the strategies shaping portfolios and help you make sense of the market chaos.
Peter, great to see you again. The last time we got together, it was before the election. We were talking about the country coming to a breaking point. We both thought that Trump would win the election. We were right. Everyone's been euphoric. Stocks have rallied even further. The economy seems remarkably strong. And yet, I don't think that any of the issues that we talked about before have been resolved. And so I think that the people who are big fans of Trump and expect a roaring stock market and a continually strong economy are going to be very disappointed. And I wanted to talk to you now, get an update about those issues, and see how you've been.
Yeah, well, even though we both thought he would win, I think it was still a surprise. You know, sort of PTSD from last time around where, you know, you went to sleep thinking that it was in the bag and the election was done. Then you wake up in the morning and you had all kinds of interesting surprises on the charts and overnight votes. So, I mean, it was still, I think, surprising for a lot of people that he won. And probably the single biggest question in terms of investing or looking after your assets is that in late Biden, we were sort of forming this stagflationary storm on the horizon, right? So inflation has been rising over the last couple of months. That was reversing the sort of gradual come down after the huge burst back in 21. Inflation was rising and the economy was slowing. So we had all these ridiculous revisions where, you know, like the Bureau of Labor Statistic would lop off 800,000 jobs and say, hey, sorry, guys, we thought they were there. They weren't really there. But it was just obscene.
Well, I didn't mean to interrupt you. Sorry. I just wanted to say that I think that when the numbers finally all come in, what you're going to see in 2024 is very clear in the economy, which was that government spending was just out of control. All the different levers that the Biden administration could pull to juice the economy got pulled. And I think if you look at the end of the day at private sector employment, we're going to find out that 2024 was the beginning of a big increase in rising unemployment rates. And they covered that up by having enormous amounts of new government jobs that were being added. And of course, this is going to result in a lot more inflation. People haven't figured this out yet, but it's not that hard to do the math. When you're running a 7% of GDP deficit, and you're hiring all these government workers, those folks are not very productive, and you're definitely going to have higher than expected inflation. And that inflation is now pushing interest rates much higher. When's the last time you saw the Federal Reserve begin to cut interest rates on the short term, and yet you have seen the interest rates on the long term go vastly higher? We've seen, what are we now, 100 basis points up on the 10-year Treasury from before the election? That is a very big change in the bond market, and yet the stock market continues to go higher and higher. And when you look, the one thing I hope people will take away from this interview is this idea. Peter, when you look at the CAPE ratio, and I know you know what that is, but to explain it to the viewers, this is a way of looking at how expensive stocks are over the very long term. So you take the 10-year average of all the corporate earnings, you adjust it for inflation, and then you measure where all the stock prices are. And that ratio historically has bounced around between around 10 and around 20. Under 10, stocks are super cheap, like they were in the early 1980s. Over 20, stocks get expensive. And typically, this CAPE ratio peaks at around 30. So if it goes over 30, you're going to have a crash. That's what happened in 1929. And 2000, the CAPE ratio got all the way over 40. And of course, we had a very bad following decade for stocks. Stocks basically fell from 2000 all the way to the end of 2008. Well, we're back there. The CAPE ratio is now 37, Peter. And whether anybody wants to admit it or not, this means we are going to have a very poor period, multiple years, maybe a decade, maybe more of poor equity performance because stocks have already priced in all of the possible good news of this election. And now we've got interest rates marching higher. And I don't know if you'll agree with me about this, but that is a recipe for a big collapse in stock prices. What do you think?
I think there's a very big risk of that. As you say, the market's currently a sort of priced for perfection. There's a lot of optimism after the election because people saw what happened in Trump 1.0, right? Which is that he put in this pro-growth agenda, tax cuts, regulatory cuts, just taking the sort of monkey off the back of corporate America, the regulatory agencies, the EPA, OSHA, SEC, all the rest of it. Just getting rid of that threat grew the economy just amazingly back in 2017. But the question is, are we anywhere close to that right now? Right? So recession odds, for example, they're currently running about 1 in 4. It's a pretty high number. So the probability that we're going to see a recession in 2025 is 1 in 4. Now, that's a lot better than before the election. Before the election, it was 1 in 2, right? Because everybody was expecting Biden or Kamala to run the economy into the ground. So things have improved, but as you say, when you've got a CAPE ratio of 37, you've got 1 in 4 recession odds, that sounds out of whack. And so then the question is Trump going to be able to pull off, is he going to save the economy from Bidenflation? Is he going to be able to log the kind of gains that he did in 2017, where people forget, but the 2016 economy was also really sluggish. Right? We were all talking about how terrible the Obama recovery was. We had this massive crash in 2008, and it was just limping back. And even that was running out of steam in 2016. So in some ways, we're in a similar spot, right? We've got this weak economy, and then Trump's coming into it. But, we've got massively more debt today. The economy, I want to get your thoughts on this, but is the economy fundamentally weaker, partly for the reasons you just mentioned, that a lot of the growth right now is bought by government spending, right? It's government hires. Biden hired over 1 million government workers. You've got massive deficits, especially going into the election where they just dumped out money. Janet Yellen was doing short-term bonds, which gooses the markets. There's all these kind of fake things in there. So that's my question for you. Like, are we already in a recession? Is this a question of Trump, not riding the plane, but I mean, like the plane is already diving and Trump's got to pull it out of that?
This whole scenario reminds me very much of 1972. And in 1972, to win re-election, which he won in an overwhelming landslide, but Nixon was paranoid. So he was pulling all the same levers that Biden was pulling to try to win re-election. And Nixon grew the government enormously in 72, had a huge blowout deficit, and he set the stage for a big increase to inflation. And you saw our trading partners back then, that was the Saudis, basically boycotting the dollar, saying, hey, you guys are just printing paper. We're not going to keep giving you our oil just for paper. The Middle East blew up over it. You had the 7-Day War, or was that in 67? Whatever the conflict was, I can't remember all of them. The one in 73, you had the stock market fall by 50%, and you didn't necessarily have a typical recession, but you had this emergence of stagflation, where you had a very weak private sector economy, and you had a huge decline in the dollar. And right now, we're in the opposite of that. We're in this this volcanic eruption of the entire currency world running into the dollar right now. We have this unbelievable aggregation of wealth that has occurred in U.S. stocks and U.S. bonds and the dollar. So you have look at the collapse in the pound just this week. Look at the euro. Look at the yen. You have all this incredible influx of value and wealth into America. Look at the collapse in the Canadian dollar. I was traveling in New Zealand over the holidays. New Zealand dollar is at basically all-time lows, and that goes across the board. So you have everybody who has come to believe in this American exceptionalism. Meanwhile, you've got inflation approaching 4%, And there isn't a time in the history of our stock market where stock prices don't go down when inflation remains above 4%. Can Trump keep all those balls in the air? I really don't think so. I can't tell you which one's going to blow up, but he is playing with a lot of big fireballs. He is threatening, Panama. He's threatening our trading partners. It's not going to take much for one of these things to spill out of control and go the wrong way, and then maybe his era of invincibility will shift. And if there is a shift, you've got what? 40% of the value of the S&P 500 and about 7 or 10 stocks. You've got more aggregated value has been foreign investors in the U.S. than ever before. You've got more household wealth invested in the stock market than ever before, and you've got a collapsing bond market. So you explain this to me. How on the earth can the dollar remain this strong when the losses for bond investors are horrendous? We're looking at something like on the order of $500 billion in unrecognized bond market losses in our banking system. Explain to me how Bank of America is going to pay a 4% rate of interest on its deposits. And explain to me how people are going to keep their money in a bank where they're losing 4% of the value to inflation every day. It just doesn't make any sense to me. Something, I can't tell you what's going to break, but something's going to break. What do you think is most likely to break? Where will the confidence in the dollar and the markets be shaken loose in 2025?
Yeah, so one of the big issues right now is that the federal government is facing just about $10 trillion in financing needs in the coming year. So they're going to have to go out to financial markets, or they're going to have to sell $10 trillion in debt, which is about a third of it. Now, keep in mind the entire U.S. banking system, including your grandmother, is $20 trillion. Okay, so half of that is what they're going to have to flog out into the bond markets. And the problem, just as you said a minute ago, right? All these other countries, they're all having trouble, right? We've never been in a situation like this where we were kind of on the edge of stagnation and everybody else is in trouble, right? So
China's an outright deflation. Their economy is collapsing.
Right. Right. China's in trouble for the first time since, 1990. Europe, many countries in Europe are already in recession. The other ones are right on the edge. So places like Germany, which is deindustrializing.
Yeah. Italy's been in recession for 25 years now, by the way.
Exactly. Yeah. And, Britain has just been an absolute mess. France is a mess now.
Speaking of Europe, have you figured out yet that if they stop buying natural gas from Russia, that the lights are going to go out? There is no way to power Europe without Russian gas. Has anybody done this math yet?
Yeah, no, it's pure, hopes and prayers, unicorn farts. What's amazing in Europe, what they're doing now, I think you already know this, but they've got this category of renewables. Okay, so they all, they have to burn renewables.
I think I know what you're about to say, and it makes me sick to my stomach.
They go to Romania and they find these old growth trees because they're nice and big, and they just level the entire thing. They grind them up into pellets and they burn that. So instead of burning coal, which is much cleaner than wood, by the way.
It has twice the energy quotient per pound.
Yeah, and people forget this, but oil and coal, they're pollutants.
Yeah. Peter, it's
it's
even worse than that. There is a British company called Drax, D-R-A-X. Have you heard of this?
No, I haven't heard of it.
What they're doing is cutting down longleaf pine forests in the American South. So huge swaths of pine forests in Alabama, Georgia, South Carolina, North Florida. They chop them all up. They put them on container ships. They ship them to England. They convert them into pellets, and then they burn them for electricity.
Think about carbon footprint.
So Peter, you do realize that England started the Industrial Revolution in the 1600s primarily by switching from timber to coal as the primary energy source of that country. And that increase in efficiency is what led to the railroad. It's what led to manufacturing textiles. It's what created, the steamships that guarded the world and that built the British Empire. And you have these same people in Europe who are deciding that they're going to go back to timber. I don't think that's going to be good for per capita GDP, but I have been wrong before.
It's like the cuck version of economic management, where just every choice you make is like, what can destroy us most efficiently. It's just astounding. And thank God for Europe, because they can kind of act as a canary in the coal mine for us. Now, of course, Biden was copying them as fast as he could, but at least for the rest of us who still have a brain.
As I mentioned, I was in New Zealand over the holidays for 2 weeks. And New Zealand has enormous coal resources. They've completely shut them down. By the way, the last coal-fired power plant in England closed last September. And meanwhile, China is now consuming more coal than the rest of the world combined. In fact, China consumes 30% more coal than the rest of the world combined. And what do you think all the developed economies are going to do over the next 50 years? They're going to build enormous amounts of cheap energy, mainly through coal, but also with natural gas and eventually with nuclear. And it's amazing how the developed world has willingly given up its greatest economic advantage, which is low-cost electricity. If Putin did not engineer the entire climate hysteria, he should have. The benefits to Russia from all of this nonsense are legion. And I think sooner or later, it's going to come out that all of this climate stuff was just Russian disinformation from the very beginning, because it's led to the destruction of much of the Western world's economies. But getting back to our point, yeah, Europe's in big trouble. China's in free fall. Emerging markets are actually growing and becoming more and more powerful. But something is going to have to break in the United States, because you can't have real interest rates in the United States, and we have 4% inflation, say 3% growth. That's going to give you a 10-year Treasury yield of 7%. You're going to have 7% bonds from here. That's another 40% decline in the bond market. You're gonna have a complete breakdown of the banking system because of that. And meanwhile, you've got stocks that are trading at all-time high CAPE ratio numbers. So, man, this is like watching Trump handle this economy is like watching a guy juggling dynamite walking through a live nuclear reactor. Something bad is going to happen, and I can't tell you what it is for sure, but I've got 3 possible triggers, and I wonder what you think about these. Trigger number 1, and it's the biggest risk, is that all the spending we have seen on AI doesn't actually lead to any revenue or profit growth at Microsoft, Amazon, or Facebook. And they're talking about hundreds of billions and further AI infrastructure construction. But what if that doesn't work? And we'll know that by the end of this year. So that's one big risk, because I don't think there is a business model yet for AI. I haven't seen one. I'm not saying that there won't be, and I'm not saying that over 10 years it won't be incredibly important. What I'm saying is that the initial build out of these new tech infrastructure projects always lead to disappointment. Look at the big internet build out in 2000. Same exact story. The second thing is that I believe there will be a huge problem in the banking system. I don't understand how Wells Fargo and Bank of America are going to be able to keep their depositors, because they cannot afford to pay a market rate of interest. And that problem has been swept under the rug now for 2 years, but it's getting bigger, not better. And then the third thing is, I think there is a substantial risk to something breaking internationally. China invading Taiwan is a constant risk. The something happening really bad in the Middle East, a nuclear bomb going off in Iran, any of those kind of things that can happen would really, really shake the stock market, because stocks are so expensive right now. Anything that threatens the credibility of the dollar could lead to a really, really big change in the currency markets, because the dollar has almost never been this strong versus all the other currencies in the world. So just a lot of things, a lot of tipping points that are out there. What do you see?
Yeah, I think those are things that people need to worry about. Taking the AI, you made the point earlier that the U.S. stock markets are largely holding up the entire world. I think most of the stock market equity on Earth at this point is actually in the U.S. The U.S. is 5% of world population. It's maybe a quarter of world GDP. It's most of the stock market. But you made the point earlier that that is overwhelmingly concentrated in the so-called Magnificent Seven, right? So you got 7 mega stocks like NVIDIA and Google and Apple. And that has made up at least 40% of the stock gains this year. Now, on the flip side of that, over 40% of publicly traded U.S. companies lost money last year. In other words, they should be wound up, right? If your company is losing money, you need to give the capital back to investors and go find a new line of work, right? 40%. So that is a historically high number. So when you look at the stock market, you look at the total returns, and it looks like everything's going great. But, you know, like everything to do with the economy right now, some of the things you're talking about, the surface looks amazing, right? American banks, stock prices are up. You know, they're doing fantastic, of course, because they got bailout last in 2023. But anyway, on the surface, everything looks fantastic. If we talk about the Magnificent Seven holding up the entire market, the tip of the spear, like the tip of the hype, aside from Fartcoin, is artificial intelligence, right? NVIDIA has been one of the best performing stocks, I think over the past 20 years, but certainly over the past 5 years, been absolutely on fire. One of the most valuable stocks in the world. Jensen Huang, their CEO, is out signing boobs, which is the mark of greatness in Silicon Valley. But you raise an important point, which is that when you've got a new technology, even if it's completely world-changing, something like AI or the internet, it doesn't necessarily lead to profits, right? So one of my favorite examples is there was this technology that Google came out with around 1999. And I was working in marketing in a toy company up in New York. And they came out with something called a Google Alert, which, you know, you put your company name in there and you sign up for the alert. And then whenever you appear in the newspaper, it sends you a little thing.
It's like a clipping service.
It was a clipping service, completely inconsequential. Nobody even thinks about it. The most minor thing you could possibly imagine. But you know, because you were in the business back then, there was an entire industry of news clippers, people who would sit there and go around and cut through newspapers, right? That industry got wiped out. Good riddance. I mean, it's a goofy industry, but anyway, they got wiped out, right? Probably thousands of jobs got let go. Now, how much money did Google make off Google Alerts?
None.
Nothing. Right. Absolutely nothing. And so a lot of what happened with the internet is that it took billion-dollar businesses and turned them into million-dollar business. Took, million down to thousands, okay? Google Maps, how much money do they make off that, right? Now, how much value is created from Google Maps? Yeah, it's probably in the trillions. All of us use it, right? Think of how much time, if you're sitting there with the Rand McNally Atlas trying to figure out where to go, right? Massive value. How much of it is captured? Almost nothing. So when we talk about artificial intelligence, is it game-changing? Yes. Is it as big as the internet? It's probably going to be bigger, right? Massive, massive technology. Already today, I use Grok, the way that I used to use Google search, right? Massive technology. But will it lead to profits? And that nobody really knows, right? We don't, probably the closest thing we have is the internet that ultimately led to profits, but that took a very long time. You had the boom bust in between. A lot of people got wiped out.
I'll give you a great example about all that is eBay. So eBay came along and it was a replacement for classified ads. People probably don't remember this, but it used to be you had to call the newspaper, you had to dictate the classified ad to some person on the phone, and they would put it in the newspaper for you for a week for 10 or 15 or 20 or whatever dollars. And nobody realized this except for newspaper industry insiders, but that was where 60% of newspaper revenues came from, and it's where probably 75 or 80% of their profits came from. So eBay came along with one little piece of software, and over the next decade put every newspaper in the country out of business. And those newspaper revenues didn't accrue to eBay. eBay's getting a cut of the seller's fees or the buyer's fees. I'm not quite sure how it exactly works, but it wasn't anything like what the entire newspaper industry revenues were. And so those technologies don't necessarily build profits for investors. You just said, yeah, I'm using Grok now, which is an AI device that's owned by Elon Musk's X unit, used to be called Twitter. And I think that things like that, AI, like Grok and others, are going to really have a big impact on Google's AdWords. And nobody really thinks about this, but 90% of Google's revenues and all of their profits come from AdWords. And so if AI actually changes the way people use search, AdWords is going to get very significantly impacted. And look, Google's got other great businesses. I'm not saying Google's going to go out of business. I'm just saying you could easily see a case where for the next 10 years their earnings decrease, and that is not a part of their current stock price. Trust me. So I think it's a great example that big technological innovations cause a lot of good economic things. You know, we all exist in this competing world of creative destruction, and that's great for our economy, but it isn't necessarily great for the leading companies of the day. One other story about all of this that I think really explains where I believe we are in the market cycle in regards to stock prices. In 1972, Warren Buffett held a meeting at the Colony Hotel in Palm Beach. This was for what he called the Buffett Group. This was, you know, the couple dozen of his friends from back when he was working at Ben Graham's firm. Newman Graham was the firm's name. So colleagues from Newman Graham, plus Munger and his group from Blue Chip Stamps out the West Coast, the Wesco bank guys. They're friends who they'd all done business with. They had a couple different businesses at that time. Diversified Retailing was one of them. Anyways, they got a couple dozen really smart investors together at the Colony Hotel in Palm Beach in 1972. This was the era of the Nifty 50. And Buffett said, pretend you're going to be stuck on a desert island for the next decade. Tell me one stock you'd be willing to have all of your money in. And you wouldn't be surprised to know the names. Polaroid, IBM, GM, GE. Well, if you look at all of those stocks, the annualized returns over the next 10 years for all of those stocks was negative. Nobody could imagine a decade like was coming. Nobody could imagine the amount of inflation. Nobody could imagine how high interest rates were going to go. And as interest rates go higher and higher and higher, the multiple on stocks have to go lower and lower and lower. And by 1982, the CAPE ratio on the S&P 500 was 7. Which is the 100-year low. So people went from being more bullish and more greedy than they had ever been. 1972 was the Dow high. You had a CAPE ratio of around 25. That was an extremely bullish environment, and yet they were sleepwalking into the worst decade for U.S. stocks ever. And I believe we're in exactly that same scenario. People are so bullish right now on NVIDIA and on Tesla and on Apple that they do not, it is inconceivable to them that there could be a period of declining stock prices that is meaningful and that has a long duration. And yet we know from history, we know that that's what has to happen when stocks are this expensive.
Yeah, you get a reversion to the mean, and that then sort of trickles down through the rest of the economy because, you know, if we look at wages, for example, they have not been keeping up with inflation. The jobs picture is not that great. The one thing that's been holding up is consumer spending. What's holding consumer spending up? A lot of that is asset growth. Exactly. So, you know, they printed there was a point in 2022 when $1 in $3 had been freshly printed. It was just an absolute orgy of money printing during COVID. It was done worldwide. There was something like $9 trillion printed up on a worldwide basis. And that sent asset prices soaring. It sent houses soaring. It sent stocks soaring. It sent Bitcoin. It sent any asset out there soaring. That wealth effect from that and kept people spending. But the thing is, it's not just the wealth effect that already happened. People expect stocks to keep going up. If they expect them to keep going up, then they keep spending, they keep borrowing, they keep redoing the kitchen, even though, you know, they don't make enough at work to keep up with inflation. So when the comeuppance comes, that becomes catastrophic, right? At that point, you could be looking at a 1970s scenario.
Yeah, it's very clear to me that we're in the midst of the greatest inflationary boom in United States history and maybe even in world history. And you're exactly right. If you look at M2, it goes from something around 4 trillion to something over 20 trillion in about 18 months. And all of that financial money printing, all those financial assets that boomed are still hugely inflated. But the resulting earnings will not be enough to maintain those valuations because it is so inflationary. And what will happen is purchasing power will decline, and then eventually earnings will decline, and then eventually defaults will rise. And eventually you will have what's happening in China, you will have a deflation of those assets because they are just hugely inflated. I don't know if you saw this or not, but just yesterday, some credit card default data came out that was truly shocking. So consumer credit defaults now are larger than they were at the bottom of the 2008 crash. So there is a huge weakness in the fundamental part of the U.S. economy, which has always been driven by the consumer. Have you seen that data, and did you find that alarming?
Oh, for sure it's alarming. Yeah, they were up 50% year on year. And of course, as always, they've been calling it a K-shaped recovery, is what they've been calling it since COVID. So just like the letter K, you've got some people on the top who are doing absolutely amazing. And
All the people who own assets.
that's
right?
exactly it. Right. Their banks are getting pumped by Jerome Powell. You've got everybody else on the bottom who just voted for Trump because they're not seeing it. Right? They've got 2 jobs. They got 3 jobs. Maybe they're driving for Uber at night. They're selling off their assets. There's an expression for that in Japanese. They call it the onion lifestyle, where you peel off layer by layer. First you sell the ski equipment, and then you sell some of the furniture you're not using. You just reduce, and that's the reality for a lot of people. And that is going to trickle through to all the rest of it, right? They can't spend at some point. They're already defaulting on their credit card debts. That hits banks. Banks are already in a world of trouble. What did them in 2023 was interest rates coming up, because if interest rates come up, then your bond values go down. Most of what U.S. banks own is bonds, right? And so they're likely to get hit again. You mentioned earlier that the long-term rates have been going up since the election by 100 basis points, full percent. In fact, they're up since the Fed started cutting rates, right? So the Fed lopped 125 basis points off, and we've got mortgages almost back to that level. So the market has completely ignored the Fed cutting rates.
Yeah, and by the way, the only time that's ever happened before was during the Volcker period. When Volcker first started cutting rates in 1982, that's the only other time where long-term rates just went higher, because the market had no confidence that inflation had been beaten.
Yeah. And, we talked earlier about sort of Trump spinning plates. Or no, it was juggling dynamite.
Juggling dynamite, yeah. That's my metaphor.
Nuclear reactor. It's just more colorful. So, one of the big pushes here is on the Department of Government Efficiency with Elon Musk. And he's very, very interested in that. Part of that is deregulation, which Elon is very concerned with. Trump was concerned with it as well. In his first term, he took out like 8 regulations for every one that came in. That's very good for growth. But the other part of it is spending cuts. Now, there's a lot of people who are skeptical whether they can get that through, because, of course, Congress is going to fight like hell to keep all those spending cuts. But there's an interesting sort of data point if we talk about economic risks and the likelihood of recession, which is that we can look at what happened in Argentina. All right, so Javier Milei in Argentina, he slashed government spending something like a third. That lopped about 6% of GDP out. Okay, so he just cut that much government spending, absolute massive. But the thing is, the private sector did immediately start growing. It's pretty stunning. Almost overnight, the private sector started growing. But even so, I mean, if you cut out 6% of GDP, it's, China in the good old days barely managed 6%. 6 is a lot.
And how about this, Peter? Even if he does do that, which I don't think is possible, we'd still be running a deficit.
We would. That's the thing, right? We would barely break even.
It's amazing. The only way, you know this as well as I do, the only way you can control inflation is if you get serious about reforming the entitlement programs, which are completely untouchable politically. And anything else that DOGE or whatever we're going to call it, the Department of Government Efficiency, talks about is meaningless in terms of the scope of the problems that we have financially with our government's tax and spend.
Yeah, you could get probably about $1 trillion or $1.5 trillion out. It wouldn't be that hard. You can cut the, sort of change the military so it's focused on actually defending the country as opposed to projecting force, going and invading other countries. You could probably squeeze $400 or $500 billion out of that. Pure fraud and waste is, according to the GAO, is close to $500 billion. You got a lot of crony stuff, drag queen story hour. Like the entire professional left is funded by taxes, right? So you just take out government grants. You could probably take about $500 billion out between the crony green crap, the CHIPS Act, where they just hand money to semiconductor companies. There's a lot to cut. But even so, you put all that together. I mean, if you really you would pretty much have to put Congress in prison because they would never, ever agree. You would take all of their toys away just to balance the budget. So if you actually wanted to get back to a surplus like we had in the 90s with Clinton and Gingrich, if you actually wanted to do that, then yes, you'd have to go after the entitlements. And, the biggest issue on the entitlements, I think, is really two areas. One of them is that the sort of political coalition behind Social Security has understood the importance of having everybody in the same boat. And of course, you could cut costs by just getting rid of rich people, right? Say, if you make more than $120,000 a year, then, we're going to start pinching your Social Security check, but that would erode support for it. That's one area. The other big one, which nobody wants to talk about, partly because voters hate the topic, is health costs. Right. So the way that it works in America, if you get sick, you have the right to have a Lamborghini. Okay. Nobody is ever told, like, if I got to go to drive, to buy groceries, I don't automatically get a government Lamborghini. But if I get cancer and I go on Medicaid, I get a government Lamborghini. Okay. It's not sustainable. And that is going to be a really difficult conversation. Nobody wants to have that conversation because people in general are not ready for it. But, the way that you have a sustainable medical system is, for example, what Singapore does. Many countries do it this way. You have a two-tier system. You have one system which is free. You get basic care. If you get in a car accident, go to the hospital, you're in a group ward with 8 other people, you got the curtains around you, absolute basic care. Your family's got to cook up your lunch, okay, the minimum. That's free. And then you've got another one, that's the Lamborghinis. But with the Lamborghini system, you've got to pay part of it, right? So in Singapore, it's 10%, 20, 30%. It's a climbing scale depending on how extravagant you want it. But if you want the top cancer doctor, if you want a private room in the hospital, then you've got to actually have skin in the game. That's fundamentally what we're going to have to get to, but nobody wants to have that conversation.
I agree with all of that. I've got a prediction for you. Whatever it is that Elon Musk is able to cut out of the government spend next year will be immediately replaced by soaring interest costs on the national debt because we are going to default. There is no way that we can ever repay $36 trillion or even continue to finance it. As you pointed out, Yellen financed everything on 2- and 3-year terms to minimize the costs. As that stuff gets rolled, right now, there is no difference between the 2- and 3-year rate and the 10-year or 20-year rate. It's 4% and 4.5%. Well, by this time next year, rates will be closer to 7%. And if you're trying to roll that paper, you got to finance $10 trillion of it at, let's say, an average cost now of 6%. And then that we paid $1 trillion in interest this year. Those interest costs are going to grow 30 or 40% in the next year. So whatever Elon takes out, we're going to have to spend more because of rising interest. Now, here's a really tough question to answer, which is, what is the value of the U.S. stock market when the Treasury defaults?
Yeah, so there's a fascinating moment in history. It wasn't even that long ago, and I think you're familiar with it. The European debt crisis. So that was kicked off by Greece back in 2011, 2012. And what's fascinating is that when Greece started threatening to default, the amount of debt interest coming out of Greece was lower than it was coming out of the US at the time. All right. The point being that you don't default because you can't pay it. You default because some political entrepreneur shows up and he starts talking about greedy German bankers, or in our case, Wall Street and China. It's very easy to sell voters on the concept of defaulting on the debt. What's shocking to me is why we haven't defaulted yet. It's a $100 bill lying on the ground. If you want to run for president, just promise Americans a quick $36 trillion. Just walk away from the debt. Replace it with new debt, where you're taking care of the widows and orphans, the people who don't look good in the newspapers, so pensions, things like that. Maybe you're talking about 9 trillion. You booked a 27 trillion profit. Too bad for Wall Street. They can go bust, then they can get bought up by Warren Buffett, which he offered to do in 2008, of course. So just flog them on the bankruptcy markets. China gets stiffed. Foreigners get stiffed. I think that is a very attractive idea to many Americans. And, will you have a catastrophic recession? That's the big question. And you've got kind of 2 data points there. The bad one is Weimar Republic Germany, which is kind of the go-to for hyperinflation. But you've got an interesting counterpoint, which is Brazil and Argentina in the 1980s. They were not eating their pets. They were not eating each other. They did not start a world war. It was not all that bad compared to what people imagine hyperinflation to be.
Well, you've also got Iceland in 2008, and they had a severe 2-year recession, and they came out with a much better, much more equitable, stronger economy. And in the U.S., the last time we defaulted was 1933. And at that point, by that point, you'd seen stocks decline by 90% because it was very obvious that was going to happen. So I think the next 4 years is going to be a lot different than the Trump backers expect. You and I are sitting here talking about the inevitability of a Treasury default. And I promise you, if anybody from Wall Street hears this conversation, they're going to absolutely spit up their soup. They cannot imagine that. And yet it is, if you understand math, it is absolutely, positively inevitable. It will either happen through inflation or it will happen through an outright default. And either way, stocks are not going to trade at a CAPE ratio of 37. and the inevitability of that default is going to become very crystal clear during this presidency. The runaway spending of Medicare and Social Security is not a problem for our grandkids. It's a problem for us. There will, by the end of this decade, so that's 5 years, it will be impossible to finance our government spending. And there is no political way to stop the spending, no matter what Elon Musk says.
So let me ask you, so if we get into a collapse, if we look at default, if they hyperinflate their way out of it, if one way or the other, the world loses faith in the dollar, are we going to gold, Bitcoin, something else? Are we going to reestablish?
Well, look what the central banks are doing. They're buying gold like it is no tomorrow. I think that a lot of central bankers around the world can do basic math, and you can look at their gold buying and see that. I also just heard from a very reliable source that Jim Rogers has gone 100% into silver. He has sold everything and gone completely long silver. That's a guy I respect who also knows how to do basic math. So I think that we're on the cusp of a big change in the world's monetary system where the dollar really loses all of its credibility and people will flee into gold, they'll flee into silver, and they will now flee into Bitcoin. And I don't think you have to make a choice. I think that all three are good solutions. What I don't know and what you can't know is what the real value of Bitcoin is because it depends so much on the hash rate. In other words, if more people want to buy Bitcoin, then the price will go up. If suddenly people aren't interested in it, the price could go very, very far down. And so in that regard, it's not like a real tangible asset value like gold and silver is. Gold and silver have a very well-defined cost of production. It takes energy and it takes ore. And you can know what those things are worth in terms of labor and other ways of valuing them in real terms. It's much harder to do that with Bitcoin, which is why it's so tricky to know when to buy it.
Yeah. I think gold is a lot trickier than people normally recognize. And the reason, so I did an analysis a couple of years ago where I looked at gold versus other metals that have similar supply dynamics, and concluded that about 90% of gold's value is speculation that it could ultimately be remonetized. Right. So if you compare gold to similar industrial metals, it's way out of whack. I mean, it should be like maybe $200 or maybe $50, not $2,500. I think almost all that is monetary. And at which point it's pretty easy to value it, right? You can just take the amount of money currently in the world, something like 100 trillion. divide that by the number of ounces in existence, and of course, gold is mined every year at what, 1.5%. So it's pretty straightforward. So the best model that I've seen to try to assess Bitcoin's value basically does the same thing. So, Bitcoin is not 90% speculation, it's 100% speculation, right? There's nothing else you can do with Bitcoin but try to become a money. But even there, right, you can take all the money in the world, 100 trillion, divide that by the number of Bitcoin. And then, of course, and you come out to about $5 million. Now, of course, you have to discount that because who knows when this is going to happen? Is it going to happen in 50 years? Is it going to happen in 100 years? Is it going to be some other cryptocurrency that comes along? Are they going to manage to kill it somewhere between now and then? But, I think fundamentally when we're valuing the numbers, for me as an economist anyway, it comes down to point one, will fiat die? I think there's very good odds of that. It has historically, time and time again. Number two, if that happens, when will it happen? Because as you know, net present value, you have to discount everything into present terms. If you're betting that NVIDIA is going to make a profit 500 years from now, that's not worth very much. So when will it happen? And then point three, if it happens, who is going to replace it? And I think you make a good point about silver. I had never looked at silver, but it's held up very well. I mean, if you go back to Nixon, silver has held up just as well as gold, maybe surprisingly. Do you have any thoughts on why that is?
Yeah, I do. Of course, as you know, for all of recorded human history, gold has been the money for rich people and silver has been the money for the working class. And that's, of course, because of the relative value and the relative scarcity of those metals in the Earth's crust. There's also historically been a pretty firm ratio between silver and gold, where traditionally gold was worth about 16 times more than silver. And now that number is way higher. I forget exactly where we are in the silver to gold ratio today. You can do some basic math. It's not hard to figure out. It's somewhere like 50 to 70. And there's a lot of speculation that will change, that as those metals become monetized again in a lot of places around the world, that silver ratio gives investors a lot more leverage. So if you want to there's a lot of people probably watching us who have never bought precious metals, but they have bought cryptos. And so if you think of gold, that's like the Bitcoin, that's like the standard. And then you've got something like Solana, that has a lot more volatility. That's more like the silver. And so I think that if you believe, what I believe, and I want to be really clear about what I believe, because I don't want people to say that I was hedging or that I didn't see this coming. There is no way that we can stop the spending in our current political system. It cannot stop. And we know that because of the power of the bankers, we are not going to default. That's not going to actually happen. What will happen is the kind of default that we had in 1973, 74. You will just have runaway inflation in this country. You'll have monetary repression. You'll have inflation that's running at 6 or 8% a year, and you will have manipulation of the bond market so that there is no way to protect your savings if you're in the dollar. And that will force people to go into Bitcoin, to go into gold, and to go into silver. And that's already happening, by the way. If you look at any central bank around the world, they're all getting out of the dollar as fast as they can because everybody can do the basic math. What's going to be interesting is this will be the first time you see the United States government actively defaulting through inflation where we have a genuinely free press. The last time this happened in the 70s, there were 3 networks. They were all controlled by government regulators. No one was able to tell the truth. But now you've got Twitter and you've got all kinds of things like YouTube. And by the way, this kind of discussion that's now going to be reaching millions of people. So the stampede out of the dollar could really be something we've never seen before. And that's the only thing that could limit the government's ability to print. That's the only thing that could lead to an outright default, only because, as by the way is happening right now in Britain, there is simply a complete stampede out of the currency and no one will hold it anymore. Anyways, all these things we're talking about, they are the real crux of what's happening in the economy. They are what's really happening if you understand math. And none of this is priced into a U.S. stock market that's trading at all-time 100-year peaks in valuation. So regardless of what exactly happens next, it is going to be a very rocky ride. And the people who've gotten used to making 13% a year in the S&P are about to get a very cold bucket of water to the face.
You make some great points on the question of how fast this information spreads now. right? This is something that the Federal Reserve was worried about this in 2023 when the bank runs were running. And they said, look, in the old days, bank runs used to take months and months. Even in 2008, Silicon Valley Bank was like 72 hours, right? And the reason is social media, and especially now that we have free speech. So we're having this conversation. The LA fires are going on right now. And you can go on to Twitter or X, and you can get every last bit of information. Which street, what's causing it. They don't have water in the fire hydrants, all this crap the LA government pulled. And then you go to the mainstream press, and it's just garbage. They have no idea what's happening.
Yeah.
They're feeding you these stupid canned lies about global warming, right? The contrast between night and day. And so just like you say, in the 1970s, that mainstream press could keep a lid on stuff, right? They could tell you that banks were safe when they're not. Of course, fractional reserve banking means the entire banking system is always bankrupt. They never have the money in the vault, but they hide that. As you say, now that we have this social media age where the truth gets out there, and I want to share something related to that. This was an analysis that the Financial Times just reported last week. They said out of the 12 elections last year in developed countries, every single one, the ruling party lost vote share. And that was the first time that that happened since 1900. All right, and they're calling that a crisis of democracy. Point being that everybody hates their government.
It's not a crisis of democracy. It's a crisis of paper money. The entire international financial system is crumbling because it is not capable of maintaining productivity for wage earners. And that has been going on now for 50 years, and the wage earners are sick of it. If you're not wealthy enough to buy gold, to buy silver, to buy Bitcoin, to invest in real estate on a leveraged basis, over the last 25 years, you have seen your standard of living get destroyed to the point where in many developed countries like New Zealand, like Argentina, like in Great Britain, the wage earner is not capable of buying a home. It's not possible. It's not possible for them to save. And so you will see all of these societies on the cusp of revolution over the next 5 years because just electing the other party is not going to solve these problems. And it doesn't matter what Trump promises or what Milei promises. If you do not restore the financial order, there is going to be a huge problem in the world. And how ironic will it be that a country like El Salvador ends up becoming one of the wealthiest societies in the world in the next decade because they have Bitcoin and because they have gold mines. And they just announced, by the way, they have found a gold mine that they estimate has $1 trillion of gold in it in El Salvador. It's amazing what happens when you fix your economy and you start paying real wages to people. All of a sudden it gets very productive and lots of things can happen.
And thank God that we've got rulers out there who actually care about growth, who care about the countries. That's the saving grace fundamentally. Like if you look at the fall of the Soviet Union, if the Soviet Union were alone, like if they had won and the entire world were part of the Soviet Union, it probably never would have collapsed. Right. The key to it was that they could see what's happening in these other countries. They could see that, you can have blue jeans in the West and, blue collar construction workers can own a car. They can go on vacation, on airplanes, all these amazing things. And so that countries like El Salvador, more and more countries in the West, as they start to go populist, we've got maybe some right populist parties in Europe who might take power this year. Those are going to serve as examples for the people who are still trapped in the prison. And this kind of process we're talking about could snowball, right? It could become this self-reinforcing process. And in terms of investments, that then makes it interesting because the voter enters the conversation, right? It's no longer the elites covering each other's butts, pretending that the banks are solvent, the Fed feeding in enough liquidity to put out the fires so that nobody can see the smoke. They don't actually fix the problem. They just cover up the problem. Once the people enter the conversation, you are looking at long-term, it's a good thing, right? They can fix the problems, but short-term, you've massively raised your odds of some sort of crisis, especially with a financial system that, as you know, is so over-leveraged as ours is today.
I'll tell you one last thing before I let you go about the Russian collapse. It wasn't even the blue jeans. What really did it was the cigarettes. Russia was so badly run, and there was no productivity to the point where they couldn't even manufacture their own crappy cigarettes. And Gorbachev, shortly before he was deposed, begged Philip Morris to send him enough cigarettes to quell the unrest. And Philip Morris, to its credit, did. It sent Russia $1 billion worth of cigarettes. And to this day, the leading brand of cigarette in Russia is Marlboro.
Yeah.
And most people don't realize this, but in most places around the world, cigarette usage continues to increase. So everyone thinks of that as a dying or dead business, but it's not in many places, including Russia. So I don't know what that tipping point will be. I can't imagine what it'll be in America that finally gets people to realize, oh crap, this paper in my wallet isn't worth anything. And by the way, all the money that I have in Bank of America isn't worth anything either. I better go do something. But because of electronic networks and because of Twitter, when that moment hits, it is going to be unlike any other crisis that anyone's ever seen. So my advice to everybody is, if you act first, you're not panicking. And what did they say in the movie Margin Call? In this business, it helps to you can win by being smart, you can win by cheating, or you can win by being first. I suggest being first.
Yeah, absolutely. You've got to be aware, and the last person holding the bag is the one who's going to pay for the whole thing. So, I mean, at least start making moves early, right? Psychologically, you're going to sleep better at night, and if the worst case scenario happens, then that's really what you're buying insurance for.
That's right. My advice is have at least 25% of your net worth in Bitcoin and gold, and have at least 25% of your net worth in high-yielding short-term paper, because you're going to want to be liquid when stocks crash. And that can happen at any time. You could wake up tomorrow morning and stocks could be down 50%. And when that happens, of course, you want to buy Coca-Cola, you want to buy McDonald's, you want to buy Philip Morris. But if you buy these stocks right now at trading at multiple decades of high price, you're bound for disappointment. So that's where we are today. A lot of people don't like hearing bad news. But I certainly would rather hear it while I can still take advantage of these opportunities instead of afterwards. So I hope if you guys are watching us or are bullish and you think we're completely out to lunch, great. I honestly hope that you're right. Meanwhile, I'd suggest a remedial math course.
Yep. No, spot on, spot on. We've got so much happening today that if you are just, leaving your portfolio be, doing the whole Warren Buffett buy and hold thing, honestly, it's irresponsible at this moment. We got a lot of stuff going either directions. Will it turn into the boom of the century, Trump 2.0? Maybe. Will it turn into a disaster? There's a possibility. But either way, this is, I think, not a buy and hold economy. You got to be active right now. You got to have your hands on it, and you got to keep powder dry.
Look what Buffett himself has done, right? He's put roughly a third of his portfolio into short-term treasuries for exactly the reasons that I'm talking about. I don't think Buffett will ever buy gold. I don't think he'll ever buy Bitcoin. So this is as conservative an allocation as you'll see him take. And this is, of course, exactly what he did in 2000 when most people don't understand this, but Buffett went to cash in 98 when he bought General Re, because doing so had the impact of putting about 30% of Berkshire's net worth into bonds, which is what General Re, a big insurance company, owned. And of course, he did this famously at the top of the market in '69 as well. He gave all of the money back to his investors, and he bought National Indemnity, which was a huge pile of bonds. So he's very good at timing the market, and even though he will never admit it, if you watch what he does, you will see that in his portfolio. And meanwhile, he'll always say, we buy and hold, which he does, but he also has been very good at market timing throughout his career. So even if you don't take our word for it, look at how much cash Buffett's now holding.
He was amazing in 2008. There was a minute there where I was rooting for him. He wanted to buy up these failed banks, right? I mean, I was like, let them go under. Let Citibank go under. Let Lehman, let all these guys go under.
Yep.
Their shareholders should be wiped out for their sins. And then they could have gotten picked up by a song. They might have been guys like Buffett, guys like BB&T Bank. Now, that's interesting because a lot of these scenarios that we talk about here, almost every single one of them, the banking system does not come out alive.
No.
When my kid was 8, he was getting into astronomy, and he would ask questions like, what if the moon crashed into the earth? Okay. And I would say, well, everybody would die. And say, okay, well, what if, the earth spun out and got further away from the sun? I say, well, everybody would die, right? Like the punchline on every single astronomical interesting question is everybody dies. On the economy, the punchline on anything interesting that happens, the banking system dies, right? And there, I think, in terms of the economy, that's actually a wonderful thing. I would love the banking system to die and to be picked up for a song by new management who's more prudent. You also want to be aware of that if you're an investor, right? So if you're just buying like an ETF like SPY and you think that you're passive investing, well, you're not, because a big chunk of that, I think 10 or 15%, something like that, is going to be in a Ponzi banking system that anything interesting happens, they're going to take it right on the chin. They'll either get wiped out or bailed out.
Sure, but I can give people real numbers about this, right? So what's the largest depository institution in the United States? It's Bank of America. All right, more Americans have a checking account with Bank of America than any other bank by a wide margin. Something like 40% of all the deposits in the banking system are in Bank of America. Bank of America has $200 billion in equity, which sounds like a lot, but really isn't when you look at the size of their total balance sheet. They also have roughly, and I'm making this up because I don't have an exact number because I don't publish it, they have roughly $100 billion currently in losses on their bond portfolio. So they've lost roughly half of their equity in the last 2.5 years to their decision to put $500 billion into bonds at the absolute market peak in the summer of 2020. Meanwhile, they haven't taken a single charge against earnings from any of those losses, and they have, in sum, paid their CEO $125 million in compensation since that investment. That investment, Peter, will go down as the single worst capital markets investment in the history of the capital markets. Bank of America is going to lose something on the order of $100 to $200 billion from one trade. And they gave the guy who put the trade on $125 million in compensation for doing so. Trust me, that will eventually come out in the wash. That you can't just cover up $100 billion, half your equity in losses. And until they bite that bullet, Bank of America is uninvestable. You cannot own that stock at all. And if I were you, I wouldn't have a single account there, because Bank of America right now can only afford to pay 0.01% interest on its savings and checking accounts, which means you're going to lose about 4% of your money there to inflation every year. At the very least, if you don't do anything else from this conversation, get your money into a bank that will pay you interest. I'm getting paid something like 4.5% right now on all the cash that's in my Interactive Brokers account. That's all you need. That'll at least protect you from inflation. But if you're doing business with Bank of America, you're doing business with a whole bunch of crooks. And eventually, one day people are going to wake up and go, holy hell, what happened? And all their money will be gone. Don't be that person.
I'm actually surprised people still put money in banks. I've used Schwab as my bank since I was 20. You put your money over there, you invest it in stuff. If you don't want to invest it, you can just leave it as cash. They pay you roughly the same interest as the bank. Well, I don't even know why people use banks at this point, but I think, what you're describing for Bank of America, I think that all the large banks in America, they may not be as bad as Bank of America, but they're all up there. They've all been playing the exact same game.
Yep.
They were lemmings into bonds, commercial real estate.
Yeah.
They play games.
We haven't even talked about that. We haven't talked about 90% default rate on every single office commercial real estate loan out there. That we're not even talking about that. We're talking about the mistakes they made 5 years ago, not the mistakes that they haven't even begun to recognize. And all that commercial real estate, by the way, gets reset this year. There's an enormous amount of office RE that's going to fail this year. But that's not really the problem. The problem is really rising inflation, the inability of the government to stop spending, and the resulting losses in the bond market, which will be catastrophic for the banking system. Peter, listen, It's been great talking to you. I hope that we can get together like this, every now and again and catch up. To do that, we should make some predictions. Where will stocks end the year in 2025 in terms of percentage gain or loss on the S&P 500?
Oh man, you got me on the spot. All right, I'm going to go with the optimistic call. I am going to say that Trump is going to get growth going. Inflation is going to be relatively muted because, because we're going to have enough growth to absorb the new money. And so I'm going to go with a 15% gain on the S&P.
You're embracing the bubble, just like Barron's.
I'm embracing the bubble. I have visions right now of me being so laughably wrong at the end of the year. But anyway, I'm going to go with 15%.
I'm gonna go minus 20%.
Minus 20.
I think, by the way, it's more likely that stocks will simply be flat. It's going to take a while for the worm to turn. But I'm going to make a prediction of minus 20% because I really do believe there is going to be a big hiccup in the bond market. I think you're going to see inflation that's way stronger than anybody expects. I think we'll end the year with the CPI somewhere between 6 and 8%. And I think you're going to have the long bond, say 20-year paper, the yield on TLT, the ETF, 20-year treasuries. I think you'll have that well above 6%. And I think that's just going to absolutely put a pin in the stock market, especially in situations that are speculative like Tesla. Tesla is a great business. Sure, they build great cars, but their earnings are very weak. And as China rolls out essentially free electric vehicles for the whole world, I think that's going to be very bad for Tesla's margins. And any company that stumbles on its revenue or its earnings in an environment where there's a 6% bond out there is going to get slammed. So I think and so remember just how concentrated the S&P is. Those big cap stocks are trading at crazy multiples, and I don't think it'd be hard at all to have a 20% correction in the stock market as yields go higher. One other prediction. So I said long bond at over 6. What's your long bond forecast for the end of the year?
I actually think the long bond is going to come down. I think that what we're looking at right now is a lot of concern over Trump chaos. I think the biggest tell on that has been Buffett, right, the new Treasury Secretary. So he did not go with the bomb thrower, the sort of agent of disruption who was Lutnick. He went with the relatively conservative guy. And I think that's because Trump is aware that bond markets cannot be trifled with, and he's trying to calm them down. A lot of the fiscal stuff that he's doing, you've mentioned a couple times that he talks at a certain scale, and then the reality tends to not necessarily be that scale. If you combine that with the choice of Buffett and the sort of priorities that implies, that Trump is focused on stability. He's been in real estate, he's been in the banking world for a very long time. He does understand how these things work, I think a heck of a lot more than really any president since Calvin Coolidge. So yeah, I think that bond yields come down. I think a certain amount of it right now is just fear of the unknown.
Well, I certainly hope you're right. Any other predictions, markets that we want to go on the record with? Just stocks and bonds are pretty important.
Yeah, wow. I mean, DOGE. So, that's the big question. Is DOGE actually going to cut anything?
Okay, that's a good one. Will federal government spending actually decrease in 2025?
Okay, I'm going to put that down $300 billion. Not down nearly enough as it should, but I think that there's actually going to be cuts in that. And the reason is because public opinion polls have about 75% of Americans want cuts. In fact, there was a poll recently, a majority of Kamala voters want federal spending cut.
But nobody wants their federal spending cut.
True.
So I'll go plus 300 billion.
All right, so you're plus 300.
Yeah, you're at minus 300. I'm at 6%. You are basically 4.5 or lower on the long bond, and you are plus 15% on stocks. I'm minus 20.
Yeah.
So we have a real good bull and bear case here.
What's the stakes here? Alcohol or cigars?
If I'm in Orlando, you'll take me out to Charlie's. And if you're in Baltimore, I'll take you out to the prime rib.
That'll work. Perfect.
Okay, buddy. Thanks so much for the time today.
All right. Yeah, definitely. See you next time.